Hello, everyone. Welcome to Market Bites again. Special one every quarter. We do a review of the latest eToro retail investor beat. So you'll see us again in 3 months' time discussing the next version, which we've just been working on behind the scenes. But for now, we'll discuss the last 3 months. And I've got the dream team with me today, Brett and Neja. Brett, how are you doing?
Doing good. It's, we're rolling through the nice summer, so can't complain. How are you guys?
Yeah, very well, thank you. Very well. I look out the window here in Canary Wharf in London, and it's a pretty bad day to be a cloud spotter because there's none at all. It's blue skies, happy days over here at the moment. Tomorrow is going to be 34 degrees. We're filming this on the 11th of August. So tomorrow is going to be a hot one. But other than that, all good. Markets, a lot of equity markets currently near all-time highs. The S&P, I think, made one very recently. The Nasdaq not too far away. So yeah, pretty good vibes in the market and weather-wise as well. So I can't complain. Neja, yourself, how are you?
Uh, just as you said, Sam, it's difficult to spot a cloud also here in Slovenia today. And as you said, the markets, they also look good. So there's not much to complain about.
No, there isn't. I'm, a lot of, these reports that we do, the retail investor beat, obviously you've always got to take a slight pinch of salt because it's, done a while ago. This survey, for example, was done the 14th to 29th of May. But it will be interesting into the future. There's obviously going to be periods where these surveys are going to be done where there's a drawdown that happens. Those will be very telling and interesting, I think. But ultimately, retail investors are a resilient bunch. And if you look over the last, let's just go 6 years, there has been periods where the market's come under pressure. Certainly 2020, 2022 was a tough year. Beginning of last year, tough. Beginning of this year, tough, and we're trading at all-time highs. So in the S&P 500, so they've got every right to be pretty resilient. Just for those that are tuning into the Retail Investor Beat podcast that we do for the first time, so this is a survey of 11,000 retail investors across 13 countries, 3 continents, and as I mentioned, conducted from the 14th to the 29th of May. So yeah, that's our focus today. The first thing I wanted to discuss, and then I'll come to you guys for some questions as well. One of the main findings for us in the UK was investors were a lot more confident about their portfolios than the UK economy, which didn't necessarily surprise me, but also made me chuckle. I think in the UK as a whole, and a lot of people that are listening to this from the UK will agree that certainly politically and all of that kind of stuff, there's been a lot of ups and downs, and having any confidence in that in the short, medium, or long term is tough. And when we think about people's confidence in their own portfolios, markets have been so resilient, haven't they? As we said over the last few years, and also when it comes to retail investors designing, making, managing their own portfolios, they've got the ability to do whatever they want. They don't need to report quarterly. They don't need to update investors. So it's quite a lot of freedom. You can literally choose the investments you want, whereas you can't control the goings on in your own country and own economy. So I think they've got more control, and I think that's helpful. We've seen the worry this year in the UK about inflation, about interest rates now potentially going to go to the upside, much like other parts of the world. And the US has had the worry about oil because of the geopolitical event. Interest rates maybe until last week were looking like September was going to happen. Tomorrow, for those that are listening today on the 11th on Tuesday, tomorrow we've got the US CPI. That's going to influence things as well. So it wasn't necessarily too surprising. And also when it comes to the UK, we're actually quite a diversified group of investors. We don't just put all our eggs into UK assets. A lot is into the US and into Europe. And I mentioned the S&P 500 trading at all-time high. The FTSE is as well. But the US has just been killing it over the last few years. And, if for whatever reason the UK does struggle, you know, there are other parts of the world that do okay, and just so happens that at the time of recording, both of those areas of the world are trading at all-time highs. So I can understand why people are more confident in their portfolios than than the UK economy. Things can of course change, but you know we go into this period now, end of the middle, you know, middle end of August, and the market would probably reflect that again now, even though this was done back in May. Brett, I'm gonna come to you next. Bit of a follow on from it, but do you find investors are becoming a little bit more disciplined, or you know, more optimistic? We've had a good run, as I said, over the last 6 years or so.
Yeah, I think it's kind of both, and they do kind of work in lockstep, right? So investors, when they are being more disciplined, and then like you said, we have these couple of great years of returns, it kind of like builds that confidence, right? Like it's you're seeing your investments, you're seeing that discipline pay off, you're seeing your investments go up. It like boosts that confidence, right? When we look through the numbers, we saw I think about a third of investors increase their contributions in their investments, and about another third plans to increase those investments further when we look ahead. So that, to me, really reiterates the sort of disciplined approach from retail. We've seen such a shift, I think, not just doing these surveys, but anecdotally, when you're like just observing the retail investors. And for the three of us, we have webinars, client events. We see these people on, FinTwit. We get a lot of interaction with retail investors, and to see the sort of like, not that it was every retail investor, but the sort of like YOLO approach to 5 or 6 years ago, coming out of COVID, the short squeeze, like let's break the system type of thing. Like that mentality seems to have washed out quite a bit, and it's more methodical investing, more regular cadence of investing, whether it's biweekly or monthly. That's not to say investors don't take individual positions or mix it up on a risk reward basis once in a while, but the approach, I think, is a lot different. And to me, they kind of go in lockstep, right? Like more discipline into what has been a very strong backdrop for the last several years. It sort of like breeds that optimism a bit. And we saw a pretty similar finding in the U.S. as well. An increase in confidence in investors' investment goals, achieving those investment goals. They inched up both in the global survey and the U.S. survey, but they're nowhere near I would say, the level of increase that we saw in terms of actual increases in investment. So I think that's a good trend. I think that's we don't want overconfidence from retail, right? We don't want to be arrogant.
No, it's always funny. Just on the overconfidence, the beginning of the week, there was a few sentiment surveys going around, and it's like it's the highest it's been since 2021, where then the market crashed in 2022 or previous years. And you always think, you don't want the market to be super confident. Everyone, because then there's no one less to convince to buy it to go higher. And then likewise, when we're in a period of significant drawdown, you always want every single person to be bearish, because that can sometimes mark the bottom. It's a funny old way of looking at the markets. Nezha, just on this report, and actually we'll put the link in the bio for anyone that does want to check out the release in a little bit more detail. There was some interesting sort of findings between savers and investors. Is that divide still there, or is it maybe a little bit more meaningless at the moment?
I think that's more of a traditional divide, and as you guys already emphasized, that there are so many that retail investors are in general becoming more and more educated, so it's difficult to just divide them on savers and investors, and they're clearly not just saving or investing, because when we look at the results, around more than 50% of retail investors said that higher interest rates haven't changed their investment plans, and actually a quarter of all investors are intending to contribute more. And at the same time, when we asked them where they want to put their money, they said that they want to increase their cash and short-term savings position. That came in first place, but then we also got growth stocks right behind that, and commodities at 20%. So we have some pretty different asset classes here. And people are not saying I will take advantage of attractive rates on my cash. I still want to invest a bit of my money and be more maybe risky with it, and I think that it makes sense because no one wants to stay behind the market. At the same time, you want to be invested and also have some cash on site for all the liquidity. And Sam, as you said, markets are currently on all-time highs, but at the same time, it's been a very difficult year for all retail investors who want to beat the major indices, and because we have so many rotations on the market during the year, so it's a pretty tough year for retail investors. And I like to see that they're still confident, not overconfident, educated, and they want to stay diversified.
Do you know what? It has actually been a tough year for stock pickers. So for
Yeah.
anyone listening to this, that is, you know what, by the way, even near beating the S&P 500 or is, I take my hat off to you, because I saw an interesting stat yesterday, and it was the percentage of stocks beating the S&P 500 is the highest since 2022, which was a very tough year
Yeah.
for investors. And I remember what that year was like, trying to beat the market, and it's because of all that rotation that you've seen, which makes it very, very tough, especially if coming back off the year that we had, the beginning of this year, then the rotation from some names that did so well previously. It's been tough. Again, for
Yeah.
those retail investors, you don't judge yourself just on a 6 or on an 8 month period against the S&P 500. It's over a longer period, and over a 10-year period, if you've absolutely massively outperformed it, and then you have an 8 month period where you're a little bit below it, it's not the end of the world, is it? It's still got to think longer term. But it was interesting to see in that, and I think it has been a tough one for the stock pickers out there, and also the medium term holders as well. But as always, if in doubt, zoom out, I think, is a good way to look at it. And also another strategy that people have been sort of looking at is and we've seen it certainly over the last sort of few years, is the buying the dip strategy. I saw again
Yeah.
last week just people talking about, oh, retail are buying the dip, institutions staying away, and I thought, last 3 times I've seen this, it's turned out to be a great decision from retail. One time it's not going to be, I'm sure, but again, then the Nasdaq rallied something like 10% in like 3-4 days, which is just remarkable when you
Yeah.
think about it. So it makes sense. And Neja, I'll come to you in a second just to speak about millennials on dip buying and stuff like that. But the leading reason for buying the dip, or decent sized declines, were long term investing, which was 48%, and accessing lower valuations for 42% as well. Now, it is obviously worth saying lower prices don't mean something is undervalued. So you'd like to think that people are actually doing their proper research into it. But we've seen historically and I'll just do the S&P 500, the average entry year decline, 12, 13, 14%, somewhere in and around that, just from the top of my head. If investors see a decent sized dip anywhere near 10% for the S&P, they're seeing that opportunity works phenomenally well at the beginning of this year. I think it did like 9.99%. I think it was at the beginning. The S&P, the Nasdaq was obviously down a little bit more. People who bought those dips in just the actual ETFs or the indexes have been rewarded. And also when there's been decent drops in these big names, you've also seen good rewards as well. I was just looking earlier at the chart of Amazon and Microsoft. On the 23rd, I think it was of March, they were down significantly, trading at levels not seen for a while, and they've recovered greatly since. So the patience there, and thinking long term is what retail are doing, and it makes sense. And I tip my hat off to retail. I feel like whenever we do this report, I'm like, okay, you guys are making good decisions. So well done, everyone there. But Neja, let's talk millennials. What are they? And do you know what? Am I a millennial? I need to Google if I am, because I don't know the exact date, but I'm pretty sure I am.
Uh,
Or maybe I'm not. What are they up to?
well, I don't know if I would consider myself a millennial or Gen Z. I think I'm somewhere in between. I was born in 1997, so I think I'm somewhere in between. But yeah, we checked on how millennials are investing, and I think that they broke some stereotypes around there, because most millennials, like more millennials, are willing to buy a dip around a dip of around 5 to 10% than last year. So, and there are less of them waiting for a huge crash. Only like 10% of them said that they would wait for decline more than 20% on the market. But what I found the most interesting here is why they are buying the dip, because they said that their motivation is long-term investing. So they're not focusing on earning like quick money schemes. They're actually focused on long-term achievements, long-term goals. So they're buying earlier, but that doesn't really mean that they're becoming more speculative. I think it actually means that they're becoming more realistic about the fact that that they probably won't buy at the bottom, but they're willing to buy more when they see the dip. And even if it's a smaller dip, they're willing to increase their contribution at that time. So I think that that also fights our overconfidence speculation about them, and you can clearly see that retail investors are becoming more and more educated.
They are. So Gen Z, for anyone listening to this and wanting to know when it starts, supposedly it's 1997 is Gen Z, and millennials
Really?
is 1981 to 1996. So there you go. But it's always interesting, isn't it, to see the difference in the demographics of what people do when it comes to declines. Because of course, if people are closer to retirement, their portfolio would look different to what it would have been for them 10,
Definitely.
20 years before that.
Totally.
I was writing a piece, funny enough, just for if someone came through PR, and I was just the question was around sort of, if you're 10 years away from retiring, what would you do? And naturally people would take a little bit less risk. But it's also worth saying, over the last 10 years, if you look at what stock markets have done, I mean, the Nasdaq is up, above 500%. The S&P 250, 60%. It's just incredible. And obviously, you want to take a little bit less risk, but you're missing out on a lot of those gains there. And it's always interesting to go down the route and look at the different demographics. However, just with all that has been said, Brett, we've always got to take things with a little bit of a pinch of salt, don't we?
Sure.
So what's your sort of wrap on what we've talked about so far?
Yeah, I mean, I think the bottom line for me is, especially we go through these surveys, what we usually do, 2 iterations. It's a quarterly survey. So we're doing this about 8 times a year, kind of like really digging through the data. It's kind of looking at different angles, trying to find, the positives, but also sort of trying to what I'd say is poke holes in poke holes in it too at the same time. Nobody's perfect. Retail's no exception. I think that's sort of one of the first things to keep in mind with these surveys is, just because, a group of people, and we see this all the time with general market sentiment surveys or even consumer confidence, right? Just because someone says one thing doesn't necessarily mean that's what they're doing at the same time, right? You could feel poorly about the economy, but you feel good about your investments, right? I think that's a perfect illustration of how two things can be sort of true at the same time, but not necessarily, having a lot of overlap. Another thing to keep in mind with surveys like this, we did the surveys throughout May, and now we're here, getting closer to mid-August, especially with Sam at the beginning. You mentioned how retail, they're not fund managers. They don't have to operate on a quarterly basis. They don't have to answer about their returns to a group of investors. So, they can shift. They can change their mind. They can be into one fund, out of another. They could, they would maybe rotate from energy in Q1 to chips in Q2. they don't have this like mandate of how or where they have to invest. So all that to really say, we did this survey a couple months ago. Investors could find themselves in a completely different spot by the end of summer, right? So this is not some, I wouldn't necessarily take May's results and expect them to be the same, when we do our next survey, and go through the findings in Q4. So I think there's just sort of like a lot of shifting within retail. I think those would sort of be my biggest takeaways at this point. I don't know if there's anything that sticks out to you guys, but I think that's kind of one thing that sticks with me with retail.
No, I'm with you. I like we said at the beginning, you always got to take it with a slight pinch and consider where the market was back in May, what was going on, and at the moment, let's just say for the next report, people were receiving the questions, and oil prices down 30% from where it was, and equities at their highs. Everyone's going to be positive, and then you do it a week later, and it's slightly different. But I always find these results fascinating. You've just always got to remember, okay, let me try and go back to that period as well. And also do remember, just because someone or our findings show something that disagrees with you listening to this, it's not the be all and end all. It's your own race, and everyone's got their own targets and that kind of thing. I just think it's fascinating to go through and see how like-minded investors are thinking. Also, we will wrap it up there for today. We will be back on Thursday in a couple of days' time to probably do a bit of a review of the US CPI number. There's a lot of earnings out as well still this week, which will be fascinating. We had some space-related stocks yesterday. Rocket Labs, AST, Space Mobile. You got CoreWeave as well. You got Cisco, I think, this week as well. Mm-hmm. So enough for us to focus on. It could be that inflation comes out extraordinarily hot and the market reverses and we're all in a bad mood. But fingers crossed it won't. Brett and Nejo, as always, thank you very much.
Thank you, and see you on Thursday.
See you in a few days.